Anthony Ruffalo, Certified Financial Planner. Today we're going to talk about restricted stock units, or affectionately known as RSUs, in the equity compensated executive world. Okay, so for RSUs, let's talk about tax, because tax is interwoven with everything that we do. It creeps into every part, every aspect of our life, from church to cigarettes, to alcohol, to income, our employers, to stocks, options, real estate. There's tax involved in everything. So here we go. RSU tax. When you get your grant, typically an RSU is restricted stock unit and you have no access to it. Therefore, at time of grant, there is no tax due. RSUs come with a vesting schedule. When you vest, that is when your first level of tax is due. So let's walk through a hypothetical example. Let's say you get granted 1,000 shares of Apple stock, and Apple's trading at $125 a share at the time it vests. When it vests, that's $125,000 in compensation, or ordinary income tax, that gets added to your gross income for the year. So if you're an executive and you make $400,000 and you get $125,000 worth of an Apple grant that comes unrestricted, your total gross is $425,000. Ordinary income tax will be due. Obviously, you have to run it through your accountant, but ordinary income tax will be due based on your marginal tax brackets. Ordinary income is the worst type of income that there is. The next level of tax is capital gains tax. Hypothetically, let's say you have your Apple stock and it goes up by 20% in value. Well, when you vested for it, it was worth $125 a share, and it went up 20% in value. So now you have $150,000 worth of Apple stock. The difference between your basis, $125,000, and your 20% in appreciation is $25,000. So you have $25,000 in a gain. What you pay in taxation on that gain is now dictated by how long do you hold it. Well, if you hold that stock for less than 365 days, it's considered a short-term capital gain, and it's more in ordinary income. Ordinary income gets tacked onto your gross. It pushes up your marginal bracket. If you hold it for 366 days, you could qualify for long-term capital gains tax, which could be 0, 15, 20, or if you're over $250,000 in income, there's a special 3.8% net investment income tax. So you could go as high as 23.8% on your capital gains tax, long-term capital gains taxes, depending on your marginal brackets, which is dictated by your income. So RSUs, restricted stock units, nothing at grant date. You pay ordinary income on the unrestricted portion at vest. And then the next level is, when do you sell it? When you decide to sell that stock, depends on how long you held it. You hold it for longer a year, you could qualify for long-term capital gains. You hold it less than a year, it counts as short-term capital gains. And your clock starts ticking on whether it's long-term or short-term gains at vest. When you vest for the stock and you have control over it, that's what starts the clock ticking on the window. So, restricted stock units, RSUs, equity compensated executives, we deal with this all the time. That's what we do, and this must be built into all other aspects of your financial planning.